Hi everybody, this is Ellman, the blue collar investor, with today's option selling question of the day. Today's question comes from Vinh. Hi Alan, I am a new member. I would like to ask you how much delta to use to enter a covered call trade for in the money strikes to get adequate protection. I am looking at AMD trading at $50.10 for the July 17, 2020 contracts. Thanks, and it's signed Vinh. Well, I certainly get this question quite a bit. What delta should I use when I'm selecting my strikes? So what this video is going to do, it's going to break down how we select our strikes and the role that delta will play in that strike price selection. Let's start off with a couple of definitions. Now, Vinh was stressing in the money strikes. Evidently, protection at this point in time is very important to Vinh. And I extend kudos to you, Vinh, for knowing that in the money strikes will give you this additional protection. So let's define the in the money strike as it relates to covered call writing. Well, the strike price is lower than the current market value of the stock. So as an example, if a stock is trading at 32, the 30 strike would be in the money. Anything higher than 32 would be an out of the money strike. Now, the premium that's generated from selling an in the money call, and what makes these different from the at the money and out of the money calls, is that that premium has two components to it. It has an intrinsic value component, the amount that the strike price is lower than current market value, and then it has a time value component, any amount above the intrinsic value related to the entire premium. So as an example, if we bought a stock at 32 and sold the 30 call for $3, of that $3, $2 is intrinsic value. The amount that the 30 strike is lower than current market value of 32. The remaining $1 is our actual time value initial profit. Once again, at the money and out of the money strikes do not have an intrinsic value component, and therefore in the money strikes lowers the break even further than at the money and out of the money strikes, which have only a time value component. So you get, with the in the money strike, you get greater protection to the downside. Now let's define delta, and delta actually has three definitions attached to it. The first definition, and the one that most people know, is that it's the amount that the option premium will change for every $1 change in the underlying security. So for example, if an option has a delta of 0.5 or 50 and the premium is $2, if the price of the stock changes by $1, the premium would be expected to change by 50 cents. So we go from $2 to $2.50 if the price went up $1, or from $2 to $1.50 if it went down by $1. Another way of defining delta, it's the percent chance that a strike price will expire in the money at expiration. So if an option has a delta of 0.5 or 50, that means there's a 50-50 chance, usually at the money strikes. If it has a delta of 0.9 or 90, that means there's a 90% chance of it expiring in the money, and that would be an example of a deep in the money strike. And finally, the third and least used of all the definitions for delta, it's a measure of overall portfolio risk. Many of you may have heard of delta neutral portfolios, which a lot of portfolio managers strive for. And so what it does is it takes its positions as it relates to delta and tries to make it a neutral position to minimize market risk. So if a stock has a delta of +1 and we sell an option at 0.5, if we sold two options at a delta of 0.5 and we own a stock at +1, that would become a delta neutral portfolio with no market risk. But generally speaking, as Vinh looks at the delta now, he's relating it to the moneyness of an option which is the the amount that the strike price is in or out of the money, and that will dictate the percent chance of a strike expiring in the money at expiration. So a delta closest to 1 gives you the most protection, and a delta closer to 0 gives you the least amount of protection. Now let's go to a real-life example with Advanced Micro Devices, Inc. that trades on the NASDAQ exchange under the ticker AMD, which is the ticker symbol alluded to in Vin's question. Now, when I received the email, it was on June 28th, 2020, and AMD was trading at $50.10. Now, since we're looking at in-the-money strikes, we know that the premium is going to provide us with both time value and intrinsic value. That's just the very basic definition of an in-the-money strike. So then the question that Vin asks is, well, now what role should delta play in our strike decision? We already know we're going with strike prices below 50.10. And what delta should we use to help us decide which of those strikes to use? Well, the question now becomes, should we be using delta at all in our decisions? And what I like to do is I like to turn to what exactly is it that we're looking to accomplish here? What are our strategy goals? So before we enter a trade, any kind, doesn't have to be covered call writing, whatever your strategy is, what is your goal? What are you looking to achieve? So we have to set an initial time value return goal range, to dictate, if we're using 1 month returns, what kind of 1 month initial return are we looking to achieve? In my case, in normal markets, it's 2 to 4% a month. I'll go up to 6% in a very strong bull market. So I know the time value that I'm looking to achieve. That relates to our strategy goal. Our goal isn't to achieve a specific delta. Our goal is to achieve a specific return. Now, the moneyness of the strike will dictate how much protection we're looking to get. And that's based on our overall market assessment. Are we in a bear market, a neutral market, a bull market? Is it a volatile market? And so that's the first thing we have to decide. What about the chart technicals? I'm more likely to be more aggressive if the chart technicals are all bullish and confirming. Okay, that's also in addition to the overall market assessment. And finally, and very importantly actually, is our personal risk tolerance. Maybe we have a very low risk tolerance and we want to go within the money strikes all the time. Or maybe we're willing to incur a little more risk and we're willing to go out of the money to possibly have the advantage of 2 income streams with the same trade, one from premium and the other from share appreciation. So one size doesn't fit all. Neither does one delta statistic fit all trades. So we base it on our initial time value return goal range and our assessment of whether we want to go in the money or out of the money. That will dictate which strike we use. Now, those strikes will, in fact, have deltas associated with them. And if we're in the money, the delta range will be between 0.5 and 1.0. That's the range, by definition, of in-the-money call strikes. So our strike decisions are not based on delta stats. Delta will be the result of our strike price decisions. Now, if we looked at an option chain, and this is the one that Vin provided to me attached to the email question, and you could see that on 6/28, AMD had in-the-money strikes. We're going to look at that, 46 and 47 in-the-money strikes. The 46 generated a bid price of 510, and the 47 strike had a bid price of 440. Now we take the information gleaned from the option chain and feed it into the blue cells on the left side of the Ellman calculator multiple tab. And here's a little snapshot of that section of the calculator. And you could see, starting on the top row, that the 46 in the money strike, remember AMD was trading at 50.10, had an intrinsic value component of $4.10. Well, that's the difference between 50, 10, and 46. So the calculator will deduct that 410 from the 510 and tell us that our return on our option or ROO is 2.2%. So our 1 month initial time value return is 2.2%. Now, upside potential, when you're selling in the money strike, there's no opportunity for share appreciation. We're obligated to sell at a lower price than the stock is currently trading for. So there's no upside when we sell an in the money strike, and that is in fact the main disadvantage to an in the money strike. But we are achieving some pretty substantial downside protection of that initial time value profit. And in the case of the 46 strike, it's 8.2%. So what that means, folks, is that we are guaranteed a 1 month return of 2.2% as long as share value does not decline by more than 8.2% at expiration. Now for the 47 strike, we could see an initial time value return of 2.8% and downside protection of that time value profit of 6.2%. Now, downside protection is not the same thing as our break even. It's the amount that a stock price can decline and still retain 100% of the initial time value profit. If you look in the middle of the screenshot at the break even column, you'll see the two break even prices were 45 for the 46 strike and 45.70 for the 47 strike. So there are pros and cons to each one, but either of these will suffice if our initial time value return goal range is 2 to 4%. We're getting 2.2 to 2.8, which certainly fits within that parameter. And also the goal of the moneyness in the money to get additional protection. And you can see the protection stats are 8.2 and 6.2. So either of those will suffice. You want to get a little more protection, then you go with the 46 strike. If you want to go with a little higher initial return and still get substantial protection, then you want to go with the 47 strike. But not by delta statistics, by defining our initial time value return goal range and then determining what the moneyness of the strike should be based on overall market assessment, chart technicals, and personal risk tolerance. That makes a lot more sense than just giving one delta stat for all in the money strikes. So once again, to review, our strike selection is based on our stated time value return goal range, our moneyness decisions, and our risk tolerance, period. Now, delta stats will reflect the moneyness of the strike, but will be the result of and not the motivation for our strike price selection. Vin, thank you so much for this question. I do get it a lot. What delta should I use? And so your question gave me the opportunity to explain why I, in my humble opinion, feel that delta should not be a determining factor, but will just simply be the result of our strategy goals rather than defining delta statistics. For those of you who are premium members, which are most of you, I just want to remind you that this Ask Alan video, number 181, can be found on the premium member site. And only you, our premium members, have access to the entire library of now 181 Ask Alan videos. Just go to the scroll down on the left side of the member site to the Ask Alan section, and then after the first 10 you can click on and you'll get the remaining 171. We'll add a new Ask Alan video every month, only available to our premium members. The titles of these are found on the right side under the resources download section. Now, we also have on the website a store which contains all of our books, DVDs, calculators, and much, much more to enhance the level of our profit returns. So please take advantage of those educational products. So there you have it, ladies and gentlemen. I want to thank Vin very, very much for that question. It's an excellent one. And of course, I want to thank everybody out there for taking the time to watch this video. I hope you enjoyed it, and I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.